Okay, let's do exercise 5-14. So I am going to go through this question because your midterm is over. I know I never made any video for statement of cash flow, so let's do that. We went through these 2-3 questions in the class, but I'm doing this question because it's a good sort of a good representative question for the kind of problems that can be in the midterm. So you know it's better to understand the concepts if you miss the class now. So remember, when you write it, you write on top statement of cash flows. That's what you are doing right now. And there are 3 sections to the statement of cash flows. You're trying to explain the change in the cash account. Okay, so if you look at the balance sheet that are provided in exercise 5-14, you see there's a $13,000 balance on January 1st, and it increased to $45,000. Now that change is $32,000. That change is what we are trying to explain. We're gonna be showing here that 32. What is 32? In fact, we're gonna explain in detail how that change happened. Okay, so cash flows from operating section. We know from other chapters, operating section is very important section because that's where the company's main business is. It has a predictive information, so important piece, right? So let's do that. Cash flows from operating section. So first thing you do is the biggest assumption. It's called indirect method of determining determining statement of cash flows. It's the indirect way of approaching. So what we do is we put net income on top. We assume that all your net income, of which in this case it is $44,000, is cash. But what is net income? Net income is sales minus expenses. I'm writing on the left side here just to show you, is equal to net income, right? I'm just summarizing. So we are assuming if the net income is cash, we are assuming sales is all cash, we are assuming expenses are all cash, and net income is cash, right? But we know from the accrual accounting this is not true. Why? Because some of the sales are non-cash sales, some of the expenses are non-cash expenses. We don't pay cash for them right away. We don't receive cash from customers right away, right? So now we have to make adjustments to this net income. So let's call it adjustments. So we have to make adjustments to it. Now, first adjustment is, let's start off with the most famous one. It's called depreciation expense. Now, depreciation expense is part of expenses here, right here on the income statement, right? It's here. It's one of the expenses. We don't pay cash for it in the same period, right? If you go back into your accounting 2-on-1 concept, we buy an equipment in 1 year, then slowly when you use it, we depreciate that asset, right? But we don't pay cash for it in the next year. Same equipment, we just slowly depreciate it, right? So depreciation expense is a non-cash expense. Now what we're going to do, we're going to add back that how much is that? It's $6,000. How did I get that number? Because I looked at the change in accumulated depreciation from $11,000 to $17,000. Why did I look that? Because if you go back in your accounting 2-1-1, your journal entry, whenever you take depreciation expense, is depreciation expense debit $6,000. So in this case, they must have done debit $6,000 and accumulated depreciation credit $6,000, right? So we know we don't have a straight information for depreciation expense, but we can see accumulated depreciation expense change in from the balance sheet. So we will add whatever that change is right here, plus 6,000, plus 6,000, right? What's the next thing we have to do? We have to look for other non-cash sales and non-cash expenses. So for that we will look at the change in the accounts receivable, because you remember, whenever we sell something and customer don't pay us in cash, we what we receive is something called accounts receivable and as an asset, because customer promises us that they will pay us, let's say in 30 days. So if you sell something for $100, you're going to make accounts receivable 100, and sales is credit by $100, right? This is the journal entry. Again, all this statement of cash flows assume that you have this prior knowledge, right? So it's a little bit tricky, but I'm going to keep it as simple as possible as you see in this problem, so that you can pick up these concepts. So I understand that these are something new for you. Okay, so here we will, because the accounts receivable increased in this case, it increased in accounts receivable by how much? By $3,000. When we look at the balance sheet, we will say, hey, we never received this $3,000, right? Accounts receivable only increase when we get this, right? And when we get this, instead of having cash here, right? Ideally this should have been cash. So here it should be cash debit. It should have been, but it's not. It's accounts receivable credit. So accounts receivable debit means accounts receivable increased. So we are saying increase in accounts receivable means we did not receive cash for it. Where? In this net income. Okay, so we are trying to always make adjustments to this net income, always. Okay, this is where for example, with this depreciation in mind, that this net income does not have, we never paid any cash in that net income for depreciation expense. So we always have this thought process going on during this time. So increase in accounts receivable is minus $3,000, and then we have equipment. Equipment is a long-term buy. It's related to investment, so we have to hold on for that, for cash flow for investing activities section of the statement of cash flows. So leave that. Accumulated depreciation is related to that. We have already taken care of the depreciation expense. Leave that. Liabilities and stockholders equity section. Now I'm going to accounts payable, the first one. Now that deals with expenses, right? So I was trying to show that in the class too. So if you are now going to think about what happened in accounts payable. Accounts payable increased by $5,000. Now, just like I was trying to explain to you about sales and accounts receivable. Now this is accounts payable is related to expenses. So if your accounts payable is increasing, there's an increase in accounts payable, right? If there's an increase, so I'm gonna if there's an increase, what that means is that we have these expenses that we have incurred, but we have not paid cash for it yet, right? And that's why our accounts payable is increasing, because whenever we did that accrual entry for our expenses, we used to do like that, like this. Let's say if we have an expense, so we bought supplies, right? It was supplies debit for, let's say, for 500, and accounts payable was for 500 credit. So that means we have the supplies, and we later on use these supplies for expenses, but we have our accounts payable increment because we did not pay. So it's non-cash expense. It's related to non-cash expense. Okay, so that means we got more money because we have not paid cash. So this will be plus $5,000. Again, I'm talking all this from the perspective of this net income. Okay, always remember. So I'm saying we have not paid cash for, so these are non-cash expenses. When I say that, I mean it's in non-cash expenses in net income that we have subtracted, but we have not paid cash for it. So that means we got more cash. Just like depreciation, we never paid any cash for it, so we increased that. We made that adjustment. Here we are also making the same adjustment. We did not spend cash for it, so we got extra cash here. Okay, so if you sum it all up, it is going to be 44,000 plus 6 minus 3 plus 5 is $52,000. This is the money you're getting from cash flow from operating activities, right? So I'm going to clear this off, and I'm going to start now the next section of statement of cash flows, which is the investing activities. Okay, cash flow from investing activities. So let's do that. Cash flow from investing. What are the investing activities? These are the let me write this here. Cash flows from operations, right? These are basically net cash flows from operations. So you put that heading. Now you got the heading of cash flows from investing activities. Then what? So I remember I talked about anything which is long term, and you make a big capital investment, or you sold an equipment or land, that relates to investing activities, right? Investment means you're making a commitment for long term in nature, 10 years, 15 years, 5 years, right? Long term. So here you can see equipment increase from 22 to 39. It's a 17,000 increase. So bought equipment because it increased. You're gonna equipment for how much? For $17,000. Okay, the $17,000 minus, right? When you buy, you have to spend cash. So that comes out. What else? From investing activities, I think this is the only one. The next one is we gotta go into the third section, which is cash flows from financing activities, right? Financing activities. So I missed here activities as well. So here, this is the third section. Here you will look for, did this company took any loan, any long-term loan, right? We are not talking about accounts payable. These are short-term in nature, and they deal with operations. So here we are talking about long-term in nature. And accounts payable is not the one of them. There's no notes payable. If there was notes payable, that would be long term. But we see common stock. These are shares issued to shareholders. So issued. So here, let's say issued. So I don't know why.